forget, honestly, whether I have had a chance to note, I don't remember whether we did last time, but last summer we saw the passing of the co-author of the Humphrey Hawkins bill, Congressman Gus Hawkins, who was a member of the House, who was a co-sponsor of the bill and had a very distinguished career. He was the predecessor of our colleague from California, Ms. Waters. But the significance of his achievement in structuring that bill, and in particular giving equal weight to two very important mandates, the need to combat inflation and the need to maintain adequate employment, I think recent events have shown that to be quite wise. I contrast what I think has been the good performance of our Federal Reserve in meeting our needs with a performance that I think has caused more difficulty in Europe at the European Central Bank, where they have only the single mandate. So I want to pay again tribute to the wisdom of Gus Hawkins and to the fidelity with which the Federal Reserve under this chairman has carried out what can be a complicated and sometimes it's a relationship with some tension. We meet today in unusual circumstances. For many years past, I have focused on the problems of income inequality in our society and the question about how we promoted growth without it adding to inequality. Both the current chairman and his predecessor acknowledged that those were issues and expressed views about how to deal with them. We have, from time to time, convened when we were in the midst of a downturn. Whether or not it's a recession is a somewhat academic discussion. That we are in a significant downturn with a very chancy near-term future is indisputable. What's interesting is the extent to which this is a very different kind of downturn. We don't have the classic cycle where there were excesses, too much inventory, etc. We are in a downturn, maybe a recession, maybe about to get one, in which the single biggest cause was excessive deregulation. The failure to understand that a vibrant, free enterprise system needs, as a partner, a public sector that understands how the market works, supports it, helps create the conditions in which the free market can flourish, but also provides a set of rules that diminish abuses. That this current downturn was caused by abuses in the loan market for residences is fairly clear. In the report, the monetary report that the chairman presents, on page 3, part 2, the economic landscape after the first half of 2007 was subsequently reshaped by the emergence of substantial strains in financial markets in the United States and abroad, the intensifying downturn in the housing market, and higher prices for crude oil. Rising delinquencies on subprime mortgages led to large losses on related structured credit products. Skipping over, consequently, in the fourth quarter, economic activity decelerated significantly, and the economy seems to have entered 2008 with little forward momentum. Now, this is relevant for a number of factors. Yesterday, in a hearing we had preparatory to this one, the very distinguished economist Alice Rivlin, a former vice chair of the Board of Governors, said, this year in your hearing, monetary policy will not be as important. It'll be somewhat down on the list. And I think that is accurate. In the classical recession we've had, the role of monetary policy is fairly clear. Here we have this problem that the normal tools we use, including a stimulus package, which in its detail pleased no one and was therefore able to pass, and I think will on balance be constructive in helping deal with the shortfall. And we have seen a reduction in interest rates. That is, monetary and fiscal policy have been as stimulative as you could expect in this time. And I support both of those directions, but they're not enough. We are dealt with the need to deal with a very serious structural problem, the continuing flood of foreclosures, and this committee will be considering measures to deal with that. Let me note that in the absence of the subcommittee chairman, and given the significance here, I'm going to take the 8 minutes that we have, and I apologize to my colleagues, but not so much. We have a structural set of issues to deal with, and in this case, relying on fiscal and monetary policy alone won't be enough, because unless we can deal with the specific structural problem caused by the deregulation more than anything else, and caused by excesses in the private sector, we will not be able effectively to deal with this situation. And in fact, if we were not to deal with this in a structural manner by trying to deal with foreclosures and with property on which there have been foreclosures, we would put too much of a strain on fiscal and monetary policy. Would not be appropriate to rely only on fiscal and monetary policy. So we will be trying in a variety of ways, and we've been talking to regulators, and I appreciate the cooperation we've gotten from staff of the Federal Reserve and the other federal regulatory agencies. We may in the end have some differences, but there's been a cooperative effort to try and figure out how to deal with that. But what is clear is that the ideology of deregulation is a large part of the cause of the problems we are in today. Indeed, in the mortgage market, it is clear, if you look at mortgages originated by the regulated entities, the deposit-taking institutions subject to bank regulation, they have performed much better than those that came with very little regulation. And it wasn't simply that. What basically happened was that securitization, which has been a great blessing and a great multiplier of our ability to do things, replaced the lender-borrower discipline. We were told by the private sector that they had ways of replacing that so that we would have a good deal of responsibility. We had risk management and quantitative models and a whole range of other things. It turns out when enough bad loans are put into the system because of the absence of the lender-borrower discipline, i.e., I'm not lending you the money unless I know you're going to pay me back, that some of these techniques did not contain the damage, they spread it. And the consequence has been a very serious worldwide problem. We are in the most significant economic troubles since at least 1998, and in America it's probably going to have more of a negative impact than then. And the single biggest cause was a failure for regulation to keep up with innovation. And it's, of course, had international consequences as well. We have a new export in America that had a big impact on the rest of the world, bad mortgages, which we exported and which caused economic problems elsewhere. So as we deal with this situation, it is important for us to continue to monitor monetary policy. We've already acted in the fiscal area. I believe that the chairman of the Federal Reserve has acted appropriately with regard to monetary policy, but that could not be enough given the cause of this. And what we need, first of all, is to deal with the problems that we have seen because of the failure to regulate, and we have got to do something about the cascade of foreclosures that we still face, or we do not easily pull out of this problem. And we have to, once we have dealt with that, and this committee will begin to work on that, think in cooperation with the regulators and the financial community and others, what we do going forward so that we do not lose the virtues of securitization, but we are able to diminish some of its abuses. Gentleman from Alabama.